Hello everyone, and welcome back. Today, we're diving into a super important topic for your CAIIB BFM paper, regulation of the banking industry, why it's necessary, what the goals are, and how it actually impacts the financial system. So, sit back, stay focused, and let's break this down in the simplest way possible. Introduction. Let's start with a basic question. Why do we even need to regulate banks? Well, think about what banks do. They take deposits from the public, that means people like you and me, and they lend that money out to borrowers. In short, they're dealing with other people's money, not their own. Now here's the catch. Banks lend out way more than they actually keep in hand. That's what we call high leverage. And because of this, they're naturally exposed to a lot of risk. One bad move, one misjudged decision, and things can spiral fast. And if a major bank fails, it doesn't just affect that one bank, it can shake up the entire economy. That's where regulations come in. Every country has a central authority to keep the banking system in check. In India, that's the Reserve Bank of India, the RBI. Why do we regulate banks? Now you might be wondering, what do these regulations actually do? At a basic level, they act like rules and safety nets. They help banks identify and manage their risks, follow proper business practices, and make sure they don't take unnecessary shortcuts for quick profits. Regulations help banks stay strong and protect public trust. The 5 key goals of banking regulation. Let's go over the 5 major objectives of banking regulation. Remember, these are not just theory, they're the core foundation of a stable financial system. Safety of the banking system. First and foremost, safety. Banks must maintain a minimum level of capital based on their risk profile. This is known as capital adequacy. Why? Because if they suffer unexpected losses, say from loan defaults, this capital acts like a cushion. It ensures that the bank can still survive the shock. So regulators like the RBI keep checking. Hey, does this bank have enough capital to cover its risk? Level playing field. Next, we want to make sure all banks play by the same rules. We can't have one bank bending the rules and gaining an unfair advantage. That's why regulations ensure there's a standard framework for everyone, whether it's a big private bank or a small cooperative one. This builds trust, keeps competition healthy, and avoids chaos. Sound business practices. Now let's talk about how banks operate internally. Regulations promote good governance, internal controls, and ethical practices. Things like avoiding conflicts of interest, having proper checks and balances, and not making reckless lending decisions. It's like teaching banks to follow good habits, so they don't land themselves in trouble. Controlling systemic risk. This one's super important, systemic risk. Let's say Bank A collapses. It owed money to Bank B. Now Bank B is also in trouble. Then Bank C, which depends on B, starts feeling the heat. See what's happening? One bank falls, and boom, a chain reaction. That's systemic risk. Banks are interconnected, and failure in one can lead to failure in many. Regulations are designed to prevent this domino effect. So regulators use tools like stress testing, risk controls, and capital buffers to stop one bank's problem from becoming everyone's problem. Protecting depositors. Finally, and this is crucial, protecting depositors' money. Let's face it, most people have no idea what's going on behind the scenes at their bank. They deposit their savings and trust the bank to keep it safe. Regulations ensure that banks don't misuse that trust. They limit risky behavior and make sure banks don't gamble with our hard-earned money. Quick recap on systemic risk. Let me pause for a second and go a bit deeper on systemic risk, because it's not just exam important, it's real-world important too. Systemic risk is basically the risk of the whole banking system collapsing, not just one bank. Why? Because of interbank lending, shared exposures, and mutual dependencies. That's why regulators now focus on something called macroprudential policies. These are rules that look at the big picture, not just individual banks. The goal? Make sure the whole system can absorb shocks, whether it's a market crash, a pandemic, or a big loan default. Conclusion. So, to wrap up, banking regulation isn't about making things difficult for banks. It's about keeping the financial system safe, fair, and trustworthy. It protects the economy, supports depositors, and builds confidence in the system. That's it for this session. I hope you found this explanation helpful and easy to understand. If you're preparing for the CAIIB, make sure you subscribe and hit that bell icon. We're covering the entire BFM syllabus in simple, clear English, just like this. Thanks for watching. See you in the next one.